recording. So it has started recording, so now it can run on the background. So I was saying that we have liquidities. The areas that we have liquidity in most occasions is session high and lows, sell side and buy side liquidity. This comes from break of structures and change of characters. I don't know if you are aware of these terms.
Yes, I know that.
Yeah, so that one is where they come from, and then we have daily highs and lows. We have weekly lows and highs, trend line liquidity. Those ones are, and then we also have the wages. Some people call it flag wages. That is also part of the liquidity. Then we have like time liquidity, but I don't believe so much in them. They are so much popular in ICT that at 12 just before the break of New York, the liquidity, the algorithm is reshuffling things, and so liquidity is being pulled here and there. I don't believe so much in them. And then we have other forms of liquidity called inducement liquidity. Liquidity. We also have engineered liquidity. Engineered liquidity is also there. What else? What else? If I'm forgetting any. I think these ones are the most common one. And then we also have other trading styles. We also term them as liquidity zones, like let's say equal highs or double tops. Equal highs.
Double tops and double bottoms.
Yes, equal highs and lows slash equal highs and lows, or double top and double bottom. Double top, double bottom. These ones are very common liquidities that we need. So again, you're going to come across several terms calling it liquidity. So generally, what I know is that people have never agreed what is liquidity, because all of us are just seeing colors. So people just come up with their own thing. Like for example, if there's a point in which market stands after taking such places, people call them liquidity. Let me add another one that we ourselves in the group there coined. It's the liquidity rate we talk about, the timely liquidity rate. Timely liquidity rate. Because we coined it. For example, when high of 1 hour is taken, the one we want, the rate, then we shift to 5 minutes. So this ones we coined it because in most occasions when the market has taken the highs or the lows of 1 hour and 4 hours, we see some changes, we see some reactions, and that shows that there could be possibility that there was liquidity in that particular point, and that is why we call it liquidity rates, because market has got no business going there when it is going in the opposite direction, because we look at them in the opposite direction. So that is also another form of liquidity. Above everything, my favorite form of liquidity, I've left it for the last, is called range zones. Now, if you want to be, that is what I prefer, and that is what now my entry is majorly focused about it. Range zones, liquidity, and also it can also it can also be seen as the trend line liquidity. Sorry, trend line liquidity. This is what I prefer currently to enter straight on, and not our normal liquidity rates. So I'll show you that one, and then there is this thing here called how do you call it? Power of 3. I don't know if you've heard about it. Power of 3. Now for these, power of 3, or some people call it AMD cycle. AMD cycle. Some people call it AMD cycle. or market cycle.
Okay.
Market cycle. Cycle is not so Western. Cycle. Yeah, African. So, so this ranges on liquidity. It is not my concept. It is a concept I took from me learning a lot of things. It's called RIMC, which means it is range, initiation, mitigation, continuation. It is my favorite entry model. It doesn't work alone. If you want to use it, if you want to use it alone, it's going to be a little bit challenging. But if you also want to, if you want to know learn more about it, is you can you can find it in a YouTube channel. Let me see if I can get the YouTube channel for you. If you want to learn about it more, you can go there and learn, because I can see now you're interested in learning about liquidity. So it is loading. I'll share it with you shortly. It's called NJT, not just trade, not not just trade. So there's this YouTube channel that I learned. I learned a lot. NJT. This yes, this YouTube channel. This this YouTube.
You don't need any of the strategy when you know what I'm going to tell you in today's video.
YouTube, this YouTube channel is the one behind these two guys. They're the ones behind the concept called RIMC model, which is a range, initiation, mitigation, continuation. So I like it. The problem is I don't like the way they are doing top-down analysis, and that is why, of course, do you see these 390 something videos? All of those videos, these videos I've downloaded all of them. Maybe let's say the ones from the ones from this is 11 months ago. This is of course I've not downloaded the shorts. I've not downloaded the shorts. I know the shorts are very many. These shorts I've not downloaded them, but on the these long videos I had downloaded. I think maybe let's say the ones of 11 months and above, like let's say from 11 months. Maybe let's just give it. I think I've watched even this one. I think from this point, the best liquidity indicator, maybe this one I need to watch and see if it makes sense. And then from this point, I think I've never watched one pair is all you need. I think I've watched. Okay, these are the videos. The rest are short videos. I've watched nearly every video you see here. Yeah, most of the shorts I've also watched them. So I downloaded all of them and watched them. So they are the ones that came. These guys are the ones that came up with this issue of range, initiation, mitigation, continuation model, which is very nice. Which is very nice. So you will go there and watch it. And then they have even a mentorship there, which is extremely expensive and not worth it, unfortunately. Yeah, it's from this NJT, but they have a better, because I've watched. There's no need of there's no need of buying the course if all they are teaching is already in the YouTube channel. So it will be very expensive for no reason.
Yeah.
That is why I'm saying it is not worth it. So I think they even changed the website. They even changed the website. It used to be totally black, pitch black. They changed it long since I was here. So let me see if I can get let's see the amount of money. I think the last time I checked it was, or they reduced it to per month. So you can see this thing is so damn expensive. This is nearly 1200 by the end of the year. And then if you're taking, even if you're taking, yeah, so I think it was not worth it. By the time I was watching, it was I think 750 for a lifetime or something. So it's worth it. Whatever they want to cover here, all of this here, if you watch their videos, it's all done and dusted. So if you're able to watch their videos here, it is not worth it. I've watched everything here and it makes a lot of sense, whatever they teach. It is like me opening a course right now, and that is the reason why I stopped posting. Because currently the strategy is very solid that I don't think some people should be getting it for free and we get jokers again.
Yeah, exactly. I
Yes.
agree with you.
So that is why I stopped posting. When I'll come back, I'll come back with a very solid course that is now combining everything instead of sharing everything. Like you can see whatever you see here on the screen. If you watch all these videos, there are very few videos, less than 100 videos of long form, and you can see they are very long form, 20 minutes, 16 minutes, 22 minutes. All the nuggets are here.
Yeah.
So for example, somebody who wanted to learn this thing from scratch would need to just watch it from the start here. This is how to learn. You watch from the beginning here, because as time progressed, this the skills changed, and they added new things. Instead of starting to watch this last video that was uploaded here like 6 days ago, it would be it has more knowledge than this, and this could be the foundation of where the strategy came from. So just in case you'll be interested,
Exactly, yeah.
I've promoted them enough. If you are interested, you will watch them.
I'll take them. I'll watch them during our morning session while waiting
Yeah,
for gas.
it's a nice. It's always a nice thing to promote good cause. I think if I was starting again, that is what I would watch. But no, uh, Celeste, don't worry. I'm having some boys here, so if you hear me talking, just know that.
No, don't worry.
I'm having some
It's
boys.
family time now.
Okay,
Yeah.
so these are the liquidity things you're going to hear about. The rest you don't need a lot of by the way, even fair value gaps have got liquidity zones. Fair value gaps. Yeah, because below every fair value gap there was some gap. It means that some orders were left unfulfilled. And that is why when the market comes
Yeah.
back to those particular zones, we get a push, a slight push. It could be a slight push or a bigger push. And then another form of liquidity that people don't talk about the most, but if you want somebody who talks about it the most, somebody called Wakar Yasim. If you check the person on YouTube, you'll find it. It's called SMT. These are smart money, uh, smart smart money traps.
Yeah, I've seen that term also. I just never watched it, but I've seen the terminology used.
Yeah. So that is another area that 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 it's always a good liquidity source. On a walk, come on in a Sunday. So let's start with session liquidity. Session liquidity is the easiest to know and the easiest to understand, which is just you go to, let's shift to normal candles so that it can be a little clearer. So there is this an indicator called session session. I don't know. Let's check the indicator.
I also have that one, I think.
Oh, you have that one. This one.
Session by Lux.
Yes.
Oh, I have the Lux Alpha one.
You don't have the Rob Minty.
I have the Lux Alpha one because it shows all the sessions.
Lux?
Lux Alpha, just like session. No, don't search the capitalization thing. Go to X plus one.
This.
Look,
This.
let me get you the right name. Yeah, that one.
Okay, let me favorite it and see how it fares on.
Just see what it's yeah.
So let me uncheck the first one. Okay. So this is what you use.
Yeah, I use it sometimes.
It's a lot. It's a lot. It's a lot. How do you? How do you? It's a lot. It's even
So
showing
it shows that, so like for example, Blue is London, but their London station starts early on. I don't know. And then, so you see, it starts with closing session. Tokyo, so obviously the sessions overlap. That's why you have the blocks overlapping each other. So yellow is Sydney and then the reddish is Tokyo, I think. Then the blue is London because Tokyo overlaps with London and then London overlaps with New York. And that's how it goes.
I think it's better. It's good. It's good because it is clear.
But because I know the times, I don't really use it much. I just want normally what I do is I'll mark the Tokyo high and low just to see this image correlation when we have a raise, a low and so on. Like session liquidity kind of thing. But I haven't yet seen a correlation. So I also don't want to overcomplicate the strategy, so I stopped actively looking at it.
Personally, I don't look at. I don't use it too because I don't want to complicate the strategy. But if need be, we'll just use it. There's no problem. So if you check here, let me use the one that I prefer. Let me use the other one. Let me hide this one for the time being. I think I like it. I'll study it more so that I can understand it. Now, these liquidity things, they only make sense if you have a higher time frame narrative. Without that, they're equally useless. Let me give you an example. So this is let me see. So this is New York, this is London, and then this is Tokyo, Sydney. Tokyo and Asian session. Let me just call it Asia session. So ideally, we expect that after every session high and low, like let's say this place here is the high, and this is the low of Asian session. So we're expecting that for after market has raided it, it should immediately give change. Obviously, it will give change in most occasions. It will give change, but it must go a long way with the narrative. Like on Friday, I was telling you guys that the day is going to be a pullback day. I don't know if you remember. It was going to sell, and actually it sold because even if we still stuck by the higher time frame narrative of buying when the daily is showing us that it's supposed to be selling, then obviously after taking this liquidity here, we would have looked for sell continuation above here. I don't know if you're seeing that because we're expecting that liquidity should be here, but he didn't do that. Same after taking liquidity here on London low being taken, and the narrative is still higher. Didn't work. So so it must have a narrative for it to make sense. That is what I really want to emphasize. That is why I don't even focus on session liquidities anymore, because if my narrative is correct, I don't care about the session liquidity highs, liquidity lows. Now on Thursday, we were looking for buys. I don't know if you remember, we were looking for buys that we even got very beautiful trades. This is an example. Taking if you only focus on liquidity zones of this day, we were looking for buys. Look at this. Session high was taken here, and then gave some slight reaction, reliquidated this zone because we were not having selling narrative. Obviously, people wanted to get some trade in it, got it, maybe got stopped here, but this zone offered an entry if somebody's narrative was sell buyers, and then eventually they got something like a 1 to 4. Makes sense. Now same, we also had the buyers of selling, and we didn't even focus on looking at liquidity raiding. Sorry. So when you got this liquidity raid in Asia, rather than got this liquidity raid, you can see the liquidity raid also matched with the right point of RSI, which is nice. Same to the other one, showing that the narrative was on the opposite direction. So we got a reaction here, and then we did not just enter. I waited for trend line liquidity to be broken, the break and retest. You see the way that trend line was very clean. I didn't just enter. So that is another trend line liquidity that was being building up. Because when the market is obeying highs and lows, it means that people are stacking in stop losses. This is where stop losses are for others. And then market push down. People entered here, stop loss somewhere here. Again, people entered here, stop loss somewhere here. Market push down, came back. People entered, stop loss above here. Then market again came down. So people now wanted to enter here, but unfortunately, the narrative was buys, and therefore we got the break. After the break, we need to trace the origin. So this is the thing. Using this trend line here, let me just pull it a little bit so that we can finish with it. For every trend line, just wait for a break of it so that it can indicate that trend line is done, and therefore we are back to the higher time frame narrative. So this is trend line liquidity. At the same time, this trend line liquidity is offering something which is very, very important, which is range. So a range, this is I don't know if I can find the best. If you check here, this is a range, or they call it a flag. You seeing this? Yes. So this is bullish flag. Yes, because it is going to lead to bullish movement. A bearish one goes like this. Yeah, on the opposite. But I honestly don't care about this thing, because the market can also go like this and still take liquidity and then push down. It depends with the narrative. So what I'm interested is to see some range. Whenever I want to take a position, I really want to see some range building up, preferably on the right side of the wedge, giving me trend line liquidity in both sides. And then I wait for a push down with momentum, and then I wait for fair value gap or somewhere here. It must have momentum with fair value gap, and then I'll enter at 50% retest or 60% retest from this high to this high. Now, this retest also, if it can give me again another range, it will show you that indeed the market is not supposed to be going this direction. If it gives you a range like this, just know that the next move is going to be very much explosive, like this. Yeah, so that is what I like the most. If my pullback is giving me range, I'm really interested in that. Like an internal range. Yes. What do they call it? Internal liquidity range. So you can also call it inducement. It depends with the school of forex you attended first. Yeah. So, like, let's see here. Are you seeing the way this movement here is very subtle? This here, this here that we wanted here, very specific. After this break, you can see that this movement is very explosive on the upside. But look at the pullback. I really liked it when I saw this pullback moving like this, taking a lot of liquidity, building another trend line. Seeing this, then it even further liquidated the session low. The session low was equally induced here. I can remember getting stopped out on this trade. I was holding that one. I remember it got in high and it pulled back. I was still holding it when it made that double bottom. Did you get stopped out here? Because my spread yeah, your stop loss was very, very tight. Yeah, my stop loss was very tight, so I was stopped out. Yeah, I just like it bigger stop there. I remember I was holding, I waited for that break and I got in with a double close. And I let that get down and then I was hopeful when it was pushing up. And I was still in when it came down and I just held it until it bounced up again. And then look at this again. After this range, we got another initiation. Subtle movement with explosive leaving behind fair value gap. Are you seeing this? So my second position was obtained on this fair value gap, this order block here, my first position. Okay. So when I see this range like this, I just need it to be broken out of. Seeing this is another trend line liquidity. Yeah. Just need to be broken out of again. Once it is broken out, this is like a break and retest. So I will enter on this is how I always prefer. I enter my first position on the fair value gap, at the fair value gap. I don't know if I were able to see, or I should magnify it a little bit.
I can see that. I can see.
So my first position.
I want to ask you that, and I wanted to put another issue with that when it came down to the fair value gap. So, and also with this from you can't step increase if it's not in profit. So they think it's martingale. So it's, yeah, you kind of have to just either you open two when you start or you wait until one. I don't know. They're very funny with it.
Okay, martingaling come in when you are stacking position on a losing trade.
Yeah, and increasing lot size.
Yeah,
So,
do not do
so I
that.
don't want to and just
You
stay on
only
the safe side.
you only add to a winning position. You don't add in a losing position.
Yeah.
So always add when you're already in profit. That one is when now you have bigger margin. But if
Yeah.
you add when you are in loss, it means that you are also equally eating onto your margin, and that is like gambling. That is why they don't like martingale.
Yeah.
Okay, so my first position was at, I like it at fair value gap, because some will just tap the fair value gap, especially gold have been doing me dirty recently. They don't go to order block. So my first position was here at the fair value gap. That is how I always enter. So just know that when I call trade, I'll be entering at a fair value gap or at 50% if the range is so big. Like let's say if this market pushed to somewhere here, I would just prefer to enter at a range. So this is where I entered, and then my take profit was this session high. Why? Because I did not. I took it actually at a 1 to 3, just like a 1 to 3. Why? Because you remember the way this day we were arranging. We didn't want to take this this all-time high.
Yeah.
So we didn't want to take this all-time high. So and then I didn't want to hold it for that long, because the market has been ranging upon taking that liquidity zone. So this thing is behaving. So I didn't want to hold it beyond this point. Furthermore, actually the best place to have taken the take profit was at this fair value gap, this order block. When the market touched here, fair value gap, order block, it was time to leave out of the market. Now, my second position, I said that if this market will come back and retap it the zone, I think it will use this one as an inducement, this first push here as an inducement, and therefore my second entry was here. This one here, stop loss here, and then I took it at around thereabout. So you see the way I'm maximizing on the range: initiation, mitigation, continuation. So let me just recap this. We have a range. A range can be in the form of widgets can be in form of flags, can be in form of trend line liquidity. I just need a range so that my so that is a buildup of liquidity. This range here is a buildup of liquidity. So for me to enter trade currently, I must see it build the liquidity on my zone. If I just see it, if this, for example, this market just push down like this, that is not a liquidity buildup. I need to see it building liquidity like this in form of flag. Of course, I don't need to mark flag, but if I just mark the one side of the trend, I just know that is trend line liquidity, flag liquidity, range liquidity, and so on and so forth. So that is something that you need to know. So when we have a range like this, the breakout is the initiation. So this is the first part, which is the range. Range can be sideways, can be going downward, can be going upwards. So we just need a range. After this range, where the market is not moving, it's moving up and down, up and down. And then we need an initiation leg. Are you seeing that leg? Initiation leg with momentum, leaving out fair value gap. It must leave fair value gap. See this extreme zone? That one was the extreme zone of entry. That was supposed to be the best place. If somebody patiently waited for that extreme zone with a very tight stop loss, let's say instead of placing it here, now you have it best just some 500. You can see the way it did its magic. So this fair value gap was the initiation of this range. Now I'm talking about this range. This range has left a fair value gap. Are you seeing the fair value gap here?
Yeah, I can see.
Yeah, there's a fair value gap somewhere here. Yeah. So
Yeah.
if you can get a fair value gap and an order block, you take the entry from the order block or fair value gap. If and let me just warn you in advance, if you prefer to take it on the extreme end like this, especially on gold, just be prepared to be missing trades.
Yeah.
So I prefer that you take it on
How constantly respect fair value gaps?
yeah,
I don't know why.
gold do not respect fair value gap. So I prefer that you take it on opening of the fair value gap like this. This is the fair value gap that we have here. So that is where my entry would be. Same to here. If you check here, this was the initiation leg. Initiation leg. This is the last place where we have a fair value gap. So you could have taken it at this zone or just at this zone. There's no problem. Or if you are tired of marking everything, you just take it at 50% pullback. Use a fib level to be able to take it at just 50% or 60%. Yeah, so I use this Gantt box here. If I'm tired of refining so much, I just take it at 50% pullback, especially when the market is moving. You're not sure if it will pull back. So this one that I was stopped out at first, I took it at 50% pullback. Now my lines are becoming many. Just bear with me. So this is where I took it. Stop loss very tight here. I just forgot that this session liquidity had not been swept. So this was my initial trade. You can see if I got it, I would have bagged easily a 1 to nearly a 1 to 5 risk to reward. If it didn't tap me out, but it wicked me out, and I would have bagged 1 to 5 risk to reward very quick. So currently I just prefer to place it at 50% next to fair value gap, or I just take it at 60% fib level, or sometimes 55. Let me just show you here my fib zones. So either I use Gunbox to take it at 50%, this zone here. After marking the initiation leg, I take it at 50%. Alternatively, if I want to be, if I feel like I should take it at the lowest zone, I take it at fair value gap. Sorry, not fair value gap, at 60%. Are you seeing this zone?
Yeah.
I take it at 50%, or actually I mark 55 and 60% pullback.
Okay.
So I prefer there, or I prefer at 50%. Now, if I have two positions that I want to enter, let's say I'm trading two accounts. I want to enter the first one, I will always prefer to just take it at 50% or at fair value gap open. Alternatively, if I'm to enter second position, I would prefer to take it at the order block. Are you seeing that? Because after if the market is supposed to pull back down here, then it doesn't need to tap me again at the same position. I don't know if that logic makes sense.
Yeah.
It doesn't
Yeah,
need
yeah,
it doesn't need to push me back to the same position. Why should it be entering me again in the same position at different account if it will take that my position as an inducement? And then I locate the order block next to the fair value gap or just slightly above the order block for a better risk to reward. And that is why you see I was able to close the first position easily because it had already gotten into profit by the time this 50% was getting into profit. So let's continue. So once we have a range can be in form of going downwards, going upwards or going sideways. Now, NJT only teaches sideways range. In most occasions, they teach sideways range. And personally, and then that is when now you can have an initiation leg, and then a continuation, initiation, mitigation, continuation. So this is the continuation leg. So this is what they teach mostly. So I've taken their concept and I've rebranded it into my own. So I would them they focus on on a on a on a on a lateral kind of range, but range is a range, especially if you add into the flag concept. So for them, they are waiting for this range in a sideways manner, and then they get a break with momentum, which is range. Let me just mark again for you to get the concept. So this is the range. Range is build-up of liquidity. Then after the range, we get an initiation leg that must leave fair value gap. Initiation leg. This leg must leave a fair value gap. If it doesn't leave a fair value gap, that is a scam in waiting. It will be liquidated. So you have to wait that you have to confirm that it has left you some fair value gap somewhere there. And then this 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 leg here, this leg that taps onto the fair value gap. Actually, I've marked order block, but it should be fair value gap. But I know you get the concept. This leg here should be really choppy. If it comes back choppy, even if it taps 3 times, just know that the next move is going to be the true market move. It will tap on that and immediately vacate that market very, very fast. So that is that. So immediately taps that. So if this moves here, a minute. So if this move here becomes very choppy like this, just know that the next move is going to be very explosive. So this is range. So this range initiation. So we have mitigation. This is a mitigation leg. Mitigation leg should be choppy. Should be choppy. If it just comes straight away, just know that it is going to take this first of all. If it comes non-choppy, it will take again this before it moves. So if it comes in choppy, then know that you are in the right direction. It should be choppy at least once or twice. Then you know that you are in the right side of the market. I'm struggling with the drawings. Just bear with me. So something like that. So this is the mitigation leg, and then now we have the continuation. This is the continuation leg. Now, which legs are the most profitable? The initiation and the continuation. Do not trade this one is what fails. This is the mitigation leg. This one fails a lot. Let's come to the chart. So this is the mitigation leg. Look at the way it is. Getting people in and out. In, and then it will chop you out, all of you, using one leg. Again, this is another initiation. This is another range. So let's continue. So you can see this is the range leg range. So like I said, range can be in form of downwards or upwards. It doesn't matter. And then we get an initiation leg to confirm to us that the market is ready to move, and that leg should leave us a fair value gap, somewhere there. Same to this is another range, very big range, and then it should leave us another fair value gap here that provides an order block, and then we get a push up. So that is one of the most powerful liquidity thing I'm currently using. Of course, the ones I'm marking, sorry, are order blocks. They are not fair value gaps. So I hope you know that. Oh, can we continue now?
Yes, I forgot I'm not muted. I just asked myself.
Huh?
I asked myself to wait empty.
Wow. I thought he's a young person. He's just of age.
He's 16.
Oh, that one is soon to be a man.
Yeah.
You should start knowing how to trade.
Let's start reading.
You need to start learning chart support and resistance. Yeah, you need to start learning support and resistance early enough. The problem is that it will impact his schooling.
Yeah, it's almost done.
Ah,
It's only 1.5 done. We can slowly learn.
yeah. So, so I hope you've mastered that concept of range, initiation, mitigation. So starting
Yes.
tomorrow, try and employ it. I know you really like when there's raid and then you just enter. But if you want to minimize your losses, try using this.
Yeah.
You will not be getting premature entries. So if it doesn't give you entry, you just let it go.
Yeah. Exactly.
Hmm. So I think that liquidity concept, we've covered the trend line, we've covered the range, initiation, mitigation, and then I don't know, we've covered the fair value. Now there's this concept of inducement. Inducement is when we have a break of structure and then the market comes and takes the low. Let me give you an example. Let me delete this. So your native language is African.
Yes. African English.
That is, English is not a native language. English is not South Africa.
That is African. It's you can say native language. I think 9 official languages.
In SA.
Yeah.
You guys, you're so generous.
But most of us only speak 2 of those languages.
English is the common one.
It's sad that we don't speak the other languages.
We have only two, and then everybody has got their own mother tongue. Everybody. Actually, there are so many languages in Tanzania than in Kenya. By the way, Tanzania they have like almost 200 plus languages.
Yes.
In Kenya we have about 40. But that one is now mother tongue, the one that you're born, that your mama speaks. If you mess things up, you marry somebody from another tribe, you mess the children up. Yeah, poor kids. So now I was telling you that the initiation leg, this leg here, see this one. These ones are the most profitable one, but it is short term. It is good for scalpers.
Yeah.
Then at the same time, you can't know when it is going to start until it has fallen.
Yeah.
But you can know if this initiation leg, this continuation leg, sorry, if this continuation leg is going to continue. This one is the only one that is guaranteed. This one is the one we trade, continuation leg. So whenever you'll be marking your entries, just try and identify this concept. It will elevate your entry big time. So this is the initiation leg. Another initiation leg is this. Using this.
Yes.
And then after
After
the
that,
yes, after the mitigation,
after every range, you have the initiation rate
yes.
and then the continuation.
After
But
every after
it might be okay.
after every range that is choppy, range is a choppy market.
Yeah.
We get a push with momentum out of that range.
Mm-hmm.
That's
Because of all the liquidity
yeah,
that's
because of the trend line liquidity here, and then we also have flag liquidity. Then coupled with other form of liquidity, we have session liquidity. This one is having session liquidity, but not a must. Again, it is also coupled with the fact that we have the big boy stepping in, leaving fair value gap. So you see, all odds are stacked in your favor, but only if, but only if you have the right higher time frame narrative. Uh-huh.
Yes.
If you don't have higher time frame narrative, these things are not going to make sense. Yeah. So with this, the initiation leg is the one we wait for. You keep adjusting your trend line and liquidity or wage or pattern or the range until you are convinced of momentum break. Without it, you're done. Now, after this, we got a break of structure or a change of character or market structure shift. The initiation leg, this initiation leg will always give you what is called a change of character. The last, the last, the first break of structure is called a change of character. Hiyo si kazi yangu. Hiyo si kazi yangu. So, ngaita mamako. The, enda muite. So the first break of structure after a series of higher highs and higher lows, or the reverse is called change of character. The change of character must have a fair value gap.
Yeah.
And it must have taken liquidity if you want it to be the most reasonable. I think I've talked about change of character in my channel, I'm not sure. So this is the demand zone because it has fair value gap that is here. Now, when we get the first break of structure, a pullback and the first break of structure, the first pullback, not always guaranteed. Second one, this first one lows here. This low here, the first one is always called an inducement, or the subsequent one, provided we've not had a major change of character or a major break of structure. The first one is always called inducement. So that is why it was taken here, and then the market went upwards. So this is now called an inducement. I don't focus so much about it because it is subjective. I don't like subjective stuff. So this is inducement, IDM. IDM, people call it IDM. Let me just write it, IDM. inducement liquidity. Now, if it has not been taken, and the market keeps pushing up, if it will come to the last one that's before the change of character, that is called engineered liquidity.
Okay.
So let me use hypothetical, the one we are used to. This concept of entry, make sure that you really learn it so that you minimize your losses. Of course, our entry of just raid and entry is okay, but only if it liquidates and doesn't close above or below that high or low. For example, if 1 hour raids, you shift to 5 minutes. 5 minutes should not be closing past or below that particular raid. I don't know if it makes sense. Maybe I'll go to the chart and explain. So for inducement, let's say we have a market that is going up, high, temporary low, a high, a temporary low, a high, a temporary low, like this. Of course, the market doesn't look nice like this, doesn't look juicy like this. That is why I stopped focusing on such things. So when the market comes back and takes this low here, it will just wicks it a little bit and then goes back. This is what is called inducement takeover. This is the IDM, inducement liquidity. Let me not. By the way, if we've gone so much, you also tell me I don't take your time a lot of time, because me, I was just feeling sleepy, and now I don't feel sleepy anymore. So if you feel, if you, yeah, I'm saying that if your time comes, or your time is over, you need to do something, you also tell me, because I can go on and on and on. Don't forget I'm a teacher. Yeah. Especially, and then this, it's been long since I taught people like this. So it's been long. So when you are getting, these are not called breakout structures. True breakout structures. These are just the temporary structure. So the right breakout structure only comes after taking inducement. So this is the real breakout structure.
Oh, now I understand.
Without inducement,
I watched it on the trend and now I understand.
yeah, without inducement taken, that is not real breakout structure. That's just a break of high. And it could be just a build-up of liquidity. Now, if we got another one, let's say somewhere here, let's say you are having this and then this. So before this, we got a sweep there again, and then now we connected with this. Now, let me just pull this a little bit so that I don't look confused. Just a minute. So let's say the market was moving like this. So this is the real breakout structure. After this inducement, only after inducement has been swept or taken out, that is when you can look for the breakout structure. If you want to mark proper market structure, so this is IDM being taken after inducement has been taken. That is when you can qualify this as a breakout structure. Without inducement being taken, that is just a break of high or a break of low. So this is now the break of structure. Now, after this breakout structure, these other ones, they are not called breakout structures. This one here, this is not a breakout structure, this is not a breakout structure, this is not a breakout structure. For that reason, change of character would only occur here. This is where change of character would occur. This is the last low that took liquidity, and therefore it is the one that we are waiting for. Now again, if we have this is how the concept can change into being tricky all of a sudden. If we have this without creating here second break of structure or break of high, if this sweeps here and then goes a break of structure, this break of structure is nullified and this inducement is transferred. See there now these things now start to look complicated if you want to look at true liquidity. So this is now again this. So you have to wait again for another inducement to be created. So these are just inducements that are being created. So if market comes back and take the last inducement here, taps onto the fair value gap or order block that was here, then now starts moving again. So let's say the market has come back, taken the first inducement which is needed, and then induced all the lows. Induced all these lows. So the last one in the category just before the change of character, this is where we should be having our change of character. So if the market took this, if only swept it, then we would have nullified this break of structure here. So this is the change of character, and then this is the break of structure. So this is where we expected a change of character to occur after this break of structure. These are not a break of structure, they're just breaks of high. So when the market pulls back, takes all the preformed lows, this last one is the engineered liquidity. This is the engineered liquidity. Engineered liquidity. I honestly don't pay attention to this text so much. Not anymore. What is important is the higher time frame narrative. That is why support and resistance work and any other things work. If you just align yourself with the higher time frame. Now, this is just for the sake of teaching people who are interested in true SMC. So this is the engineered liquidity. This is the inducement liquidity. And now, pardon?
I want to understand that with intermediate liquidity. So we had an inducement.
It is the last inducement. Let me just mark it.
The last
Inducement. Yes, in
intermediate liquidity.
Yeah.
Okay.
This last inducement just before the change of character. Engineered liquidity. Engineered liquidity is the last um, is the last IDM before the last before what was I even saying? Engineered liquidity is the last IDM just below or above change of character. Now, if we take the engineered liquidity, the next high or low should only be change of character. I hope that is clear. Is that clear?
Okay.
Yeah. Now, in a situation whereby the market did not engineer any liquidity, did not engineer loss of liquidity. Instead, just push like this. We don't have an engineered liquidity in this case. We only have IDM. This is common on lower time frames. And also daily time frame. So we only have inducements. That one is just inducement. So if this inducement is taken and this low is taken, then we already market has shifted bearish. So again, we start looking for a new inducement on the bearish side. We are expecting that this now the inducement This is now the inducement. And then we expect that this should be now extreme entry zone, this supply zone. And then this should be now change of character. The reason why I don't use these things is how much they wasted my time. Yet the real deal should be on the mastering higher time frame. If you align yourself with the higher time frame, anything else work. You will only struggle with entries, but everything will be working. Now, I think I've covered engineered liquidity. I've covered inducement liquidity. Now, let me cover something else, that is buy side and sell side liquidity. This thing just reminds me the days I used to teach chemistry without looking at textbook. Ah, the children thought that I'm very bright. They just don't know that that is all I was doing, understanding the concepts. Ah, because these things I'm telling you, they're just offered. It's something that I've studied them for a long time until now I'm aware of them. I can just write a book. I write a book without checking on them. So buy side and sell side liquidity happens in this way. Let me just still use a higher an uptrending market. So when we have a push down here, then we cause a change, a break of structure. If it is only liquidated, let's say this high here that we should be expecting as a break of structure, let's say this next one here is just liquidated, and you don't see candles closing below or above it, just know that that one is a buy side liquidity taken, because buy side liquidity taken, so we should be expecting a sales. If break of structure to the upside is taken out on weeks only, on weeks only, it is a liquidation, just a liquidation of highs. That is buy side liquidity, liquidation of high. So let me write here. We were expecting a break of structure, but it doesn't seem to be breaking. Just liquidates, curves inward. Liquidates, curves inward. That means that we are preparing, we are taking what is called a buy side liquidity. If it closes above, we should only expect a pullback. But if it wicks like this, most likely, it is coming for this sell side liquidity, the low that it initiated from. If it can't pull past this, if it can't push past this break of structure, it is coming to take this first. It is coming to take this low. Yes, it is coming to take the inducement, and then now we get the push that is causing now a break of structure. So this low that has been raided here, it has now come back to take the lows. Break of low, raid of lows is called a sell side liquidity taken. This is sell side liquidity. That is how simple it is. If it is breaking, then there's no problem. Just expect, like for example, when it breaks here, it will keep on moving. That is why some people are able to buy here, yet fib level will be telling people are buying at the break of high. You are wondering and you're expecting a market to pull back. Yes, because it is closing above the buy side liquidity, meaning that there's no liquidity there that is going to push the market downwards. But sometimes it happens that it breaks above and closes above, but it does come back in. Yeah, because it depends. The market is imperfect, and therefore, whatever you are looking at, whatever you are looking at that is closing, just higher time frame above it is weakening. Yes. That's why I also feel like 5 minutes will be closing. Yeah. And then 1 hour. 1 hour is weakening. Yeah, and therefore going to be raided. That is why I don't like this thing. You rarely hear me talk about them.
Yeah.
I don't like subjective things because I know that whatever I'm doing, it could be against it could be an against opposite no higher time frame.
Yeah.
So that is something that you also have to take note of. So with this in mind, people buy here. Yet we are expecting that when you're employing the buy high, sell high thing, that after this break of structure, you'll be expecting some. This is now premium. This is premium discount. Somebody is buying at premium.
Mm.
Somebody is buying at someone else. If this market was selling, someone would be buying around these zones. So that is why you need to be very careful with buy side and sell side liquidity.
Mm.
It is not important per se. It is not important. Don't overthink about
Yeah.
it because you don't trade pure SMC. You need only
Yeah.
what we need is momentum SMC. Of course, I've never
Yeah.
heard somewhere anybody call it momentum SMC. But if we are going to be the first one and still get a profitable edge out of it, why don't we take it?
Exactly.
Yeah. So momentum, this thing I've been calling momentum SMC lately, is just a matter of flowing with the market direction, but
Mm.
entering when you get pullback.
Yes.
If you go with higher time frame momentum and wait for pullback, and that pullback should be rangy, you're on the right side of the market.
Yeah.
So that is the focus of this current strategy we are trading. Somebody will be wondering, oh, you guys are trading RSI. Yes, just take the RSI and trade. Let's see if you'll be profitable. Yeah. Mhm. And then people don't know that you are the one who introduced me to RSI. I used to trade RSI back then and it used to choke me out. If you just want to buy when it
Now
is. Hmm?
it can make you money. Like I told you on gold, if you just kind of trade it like that, you can make money, but you have to have a proper risk management.
Yeah.
But yeah, but it's a good indicator. Like for example, if we get that momentum, when we have our entry, our rate, and the momentum,
Mm.
then you will see the RSI quickly goes to overbought on the 5 minutes. Then you wait for that pullback on 5 minutes. On 1 minute, actually, you can see it come
Okay.
down. It also doesn't just crash down. Like it's like the momentum is on the upside.
Okay. That
Then
makes.
you can carry it, and it's sort of it's like a confluence with your where your participation level is, and then you look at the RSI, okay, it's gonna pull back.
Mm.
So now when I'm more comfortable now setting buy limits and leaving it
Mhm.
because in most cases it does get me in instead of getting in a bit higher and it pulls back and I'm in a loss. So I rather set buy limits and if I get tapped in then it's okay. If I don't get tapped in then I
So
leave
it's
it.
okay. Yeah. So just as per now, you start implementing with using the fair value gap zones after the initiation leg, or try 50% pullback. If the leg is so big, try 50%.
Yeah.
Because the initiation leg is always very big that it doesn't get a lot of pullback.
Yeah, that's the thing.
You realize that, for example, if we are selling, of course, we will be having some form of trend line being formed. This is a pullback. We are on our sales. And then all of a sudden, we get a push down. If this push down is small, that is when you can see a pullback into the range. Just a break and retest. And then it will continue. Now, if this pullback is big, sorry, if this initiation leg is big like this after the range, so this is our range, trend line range. Just call it range so that it becomes easy. After this ranging here, that created a lot of liquidity. Liquidity, or you can just call it a wedge or a flag, no problem. So big like this, you won't see pullback like this.
Mm.
You will see it tapping onto the fair value gap because the momentum is so big, and then you don't know where the orders came in.
Yeah.
So with that in mind, you just wait, take your Gantt box or fib, wait for 50% pullback. That 50% should be around where the fair value gap is, and then you take your entry. However, there's one thing that I need to add here. This range should touch, if we are selling, it should touch the 61% fib level here. It should pull back 51%, 60%.
Mm.
And best if it is at 70%.
Yeah. Yeah.
That is where now, if you get this range here, it will look juicy. But if we don't get this range, if we get this range at around this place, just know that this range will be raided again so that the market can be overbought here. And then now, the market will now be confusing you a little bit. So with that, again, it has confused you. Now you don't know what to do because you took it before it was matured enough. Like for example, this was at 60. Okay, this one could have been taken. This is at 60, could have been taken. So let's say the range was happening at 60. At let's say here, you're looking for buy at 44. This is low risk. Sorry, this is high risk. You just wait so that the market to reach at least below 40. Below 40 is very good. Below 40 on these zones. Preferably should be at
For me, and below.
30 is the best. 70 is the best. I'm only warning in advance such that when we are in a trending market, like when the market now is stop ranging, like currently we are in range. That is why if I'm in range, I prefer it at 70 and at 30.
Yeah.
But when the market will stop ranging, it will be pulling back to around 60. And
yeah, it doesn't pull back. Yeah,
yes.
that's what I noticed on gold as well. That's why if you want to trade the RSI with gold, it's only the RSI. The best trades are when gold is ranging. That's how we traded last year.
Mm.
But when you start trending, you're not gonna, even if the RSI can be oversold, overbought, the market still pushes up. So that selling momentum is reduced, so the oscillator doesn't move up high in it pulls back.
Yes, let's take this for
So
example.
yeah,
You can see this one here. It pulled back to around 60 RSI. I would have taken this. Then the momentum is so big, again here, it pulled to around 56. Probably I wouldn't have taken it or I would have taken it. But I know that this is now low risk. I'm entering into low risk, which means that if I'm liquidated, I'll just enter again, meaning that I've taken prematurely. But now this is okay when it is not trending, when the market keeps flashing on the daily time frame, it's just one candle after the other in the same direction. Just anything 50 above 50 is okay. But when it is ranging like currently, you need to get it at zones like this 60.
yeah.
So I think I've explained this enough. So that range thing, make sure you factor in. Make sure you factor in this range in your entry, so that we can get the trade in the best zones possible. Now let me see if there's one I've left behind. Station high liquidity done. Sell side liquidity done. Daily highs and lows. Now daily highs and lows is and weekly highs and lows. Let's just go to the daily. For every daily high that is taken, if the market is on the upside, it will always give a reaction. Either if it is taken on the opposite side of the direction, then that is even the best direction. So let's use this one. This is a liquidity read.
Yeah.
This is daily low in a buy direction. What do you expect? This is a raid here. This week's here. If you go to 1 hour, it curved immediately after taking this. Now, another one is here. This market has been dropping for 3 days. When this one took it like this, of course, if you check here, you will find that there was some form of raid in this 1 hour. Of course, daily aligns with 1 hour and 2 hours. If you go to 5 minutes, if you go to 5 minutes and 15 minutes and 30 minutes, you will find several break of structure upwards. But if you go to 1 hour and 2 hours, you will find it. Even 4 hours. 4 hours could even be just one candle. Now, another example, that is when it is taken in the opposite side. If it is taken in the same direction, like this, in most occasions, it will give a very small reaction because it is pro-trend. Pro-trend liquidity, it is the least efficient liquidity zones. When it is pro-trend, it is extremely inefficient. So take note of that. That is why we prefer to take it on the opposite side. Same concept applies to, I don't need to shift to this so that I can confirm, but I know you can do that. You have to go and check the daily. After the daily high or low is taken, there's always a reaction. After a day is taken, there must be a reaction. Even if it is this, there was a reaction here. All these things, there is a reaction. Either on 5 minutes, if you focus on 5 minutes, you will always get maximum reaction, a reaction that is tradable. Let's see. Let me use Pepperstone. Look at Pepperstone, the weight is a little bit confused. So let's check this. If you go to 5 minutes, immediately that direction was taken. Where was it taken? So this is where the daily opened. The daily opened on this candle. Then it came. Look at this. Immediately it was taken. There was some reaction. So some people only trade this. Now let's go back to the daily. Let's go back to the daily. Now we have, was the high taken? I think if the high was taken because we are focusing on that day. Now let's check this. This here, buy side liquidity on the daily. 5 minutes, you must get a reaction. So there are some people who only survives on that one. Change of character on the daily, or on the 1 minute, and they are in.
Yeah, I've seen that.
Yeah, it works. It works very, very well.
But wow, people are afraid to stop and whatnot on 1 minute.
Yeah, so you see here 5 minutes. Yeah, 5 minutes here. You can see 5 minutes. Where was the change of character? Change of character was somewhere around here, but this was a sweep. This is where the change of character happened. Change of character there. This was just a sweep. Change of character here happened here. They entered because daily high has been taken. If they entered on 1 minute somewhere here, change of character was somewhere here around 1 minute. Stop loss just some few pips away. This is nearly 1 to 2. This is 1 to 2. Who is complaining? Scalpers don't take much risk to reward. That's 1 to 2, 1 to 1.
Yeah, 1 to 2, and they do that. In and out.
Let's see. Last one. Pro trend. Let's see this here. Like I know a certain Kenyan who trade like that. Only draws, they call it DOL, draws on liquidity. Draw on liquidity. So daily draws on the
There's
cool.
so many from another game, so many variations in echo.
Yeah, you will realize that they're just the same thing, and a
Yeah,
bunch of noise. Even support and resistance, they're just the same thing. So somebody waited the whole day.
exactly.
Somebody waited. This is where the market opened. Somebody waited for this high to be taken. Immediately it was taken, shifted to 1 minute. Look for a change of character. I know this was with this range. You're seeing some range here.
Yeah, yeah, I can see.
Seeing this range here.
Yeah,
I think if you go to 1 minute, should have offered you some change of character somewhere around this zone. Somewhere around this zone. Then you can see with this momentum, somebody trades takes it. Stop loss just above here. 1 to 2. 1 to 2 easily found. As much as it was extremely choppy, confirming that you're on the wrong side of the market. but but it went through. It went through. Went through.
yeah.
So let
Let's
me
take this
yeah.
one.
If for example you're looking for buys here and your narrative is okay, look at this. This would be your range. Using that range, just try and find a wage, a pattern, a range, zone. So this should have been your range or a pattern. You can see there was a break here, and then this one failed. This one failed here. So because your entry is somewhere around this zone, because we got this break here, as much as it didn't sustain, so it is arguable. Now again, after that, just like the one that failed, if you check here, you're able to spot some ascending channel. We got here, we got here, we got here, we got here. Then all of a sudden, we got this break here with momentum. This one was, somebody can argue that this was a break here, that there was a break, which is okay, but confirm it with fair value gap. Are you seeing any fair value gap with this break? Then it is only one break. One break is not a break.
No.
It needs to sustain. So you will need it like this. You'll have to adjust it. That is why you see I just keep on adjusting. So until I get a reasonable break with momentum and fair value gap. So after this, I can see there's a clear fair value gap here. You take your fair value, you take your thing and mark it from this high to this. This is the last high. Then you can take it on 60% or 50% or at the entrance of fair value gap. So let's say this was 50% somewhere here. So this is where you would have taken it. 50% pullback. Then stop loss is covered here. Then this was a trade. This one was a very nice one. Are you seeing the way after the tap, the leg is very big?
Yeah.
And then if you want to stack more position, again, are you seeing some range here?
There's another range.
And then you have initiation, then the mitigation, the way you see it is very choppy. Around fair value gap below here, order block. Another. Are you seeing another range?
Another range.
Then now this is big. If it is big like this, 50% is okay, or 60% is okay. Just maybe on this fair value gap here. Stop loss just here. Now, if you targeted order block, see where it is. You would have gotten good entry, yes, at an open, but that would be unnecessary. You wouldn't gotten any of that trade. Now, if the initiation leg is being very aggressive, most likely it is not going to work. You can see the way this initiation leg is playing around while protecting this leg here, this initiation leg. The range is very much protecting it, building more liquidity that is going to be raided. Again, we have another range. You seeing the range? See the break with momentum. Then we look for 50% pullback. 50% pullback. Very clear. You see, this one happened at exactly the open of the fair value. Stop loss below.
Yeah. Yeah.
This one taken. Obviously, it doesn't work. It doesn't work all the time, but at least that should be the concept you take your trades in. It will help you a lot.
Mm.
Then another thing is that
Yeah.
it will not it will not work all the time because the narrative changes. Here we are just on 5 minutes, so we don't
Yeah.
know if the narrative is about to change here or something. So that is what happened here. You can see this was the one I was talking about. We took it here with my tight stop loss. As much as the end was very much valid, I got stopped out. Hope you remember.
Mm.
I took it at
Yeah.
50%.
Yeah. Remember that.
Yeah, I took it at 50% here. My stop loss was very tight here. So I just got whipped out and stopped out. So if I just added a little bit,
Mm.
I would have survived it. Again, I still went in after this break. I've used enough examples so that you don't suffer looking for them. Very good entry. You don't need so much. You don't need so
No,
much.
it's very clear, very simple. There's nothing that's complicated here.
Nothing is
You can see
complicated
that.
here. So the only thing that is remaining here, and that is why I'm leaving it for the last part, is the narrative. You don't just come here and start drawing. Start drawing. You start drawing what? It's called uh, ranges and looking for entry. Like
Mm.
like this.
Mm.
See, this one is another very nice range. It breaks here. There is fair value gap here. At the entrance of fair value gap is just okay. Stop loss just below here. This one clearly failed because it just liquidated the high.
Mm.
Session high liquidated. This thing session high.
Mm.
Session high liquidated. And that is how again it reversed back. So the narrative changed on Friday. We were looking for sales. The narrative changed on Friday, and I was telling you guys that the narrative has changed. So you can see the way
Yeah.
there was this. Um, this is now a downward wedge. If you're having a downward wedge when you're supposed to be, this one is we are supposed ideally we are supposed to. You can see this wedge has been distorted a little bit. That means that the momentum
Mm.
is on the downward. So if it is changing, if it changes like this and doesn't break immediately, what your role is just to be adjusting the direction. Seeing this, your role is just to be adjusting the trend line, the wedge, until we get a break. Now we are not supposed to be buying; we are supposed to be selling. So you can wait.
Okay.
You can wait for the range of selling to start, so that we can have a drop down. Like in this case, this is where the range started. You seeing this?
Yeah. Yeah.
This is now where the range is. Then we get this a drop down,
Mm.
but there is no fair value gap. The fair value gap only comes here. You can see the way this one was a very heavy pullback, a very push down. So this one you mark it, and then I would have taken it on 60% pullback. I would have liked it at 60% pullback.
Okay. So you don't mark the box, the trend box. You don't place it from your top of your range to the breakout candle for entry.
You can do that if you have a fair value gap already, but you can
Okay.
see
On the what is it? The initiation lane. You don't measure that candle
you don't measure
for that entry.
the
So you see the top of the range
yes here
with that with the broke out. Yeah. Until the breakout candle
this
close
here
or wick.
this here this.
Yeah.
No, we could have done that if there was fair value gap here.
Okay, yes, yes.
There's
Yeah,
no
that
fair
makes
value
sense.
gap, and then we didn't even have enough. This is the only pullback we have. If this candle here formed a fair value gap, then you would have still taken entry from here to here. We didn't get
Hmm.
any pullback here, and then there was no fair value gap, so it was really extremely unclear. So
Yeah.
you would have just still stuck by taking the whole of the pullback. This is when I tell you like the initiation is so big.
Yeah.
So I would have taken this on 60% pullback. This is 60% pullback somewhere around here. This is 83. So maybe you can even push if you feel confident, you can a little bit push it and accept to miss trade. If you accept to
Mm.
miss trade, it's okay. Like I would have accepted to miss trade on this one so that I have tight stop loss because I know that this is
Yeah.
temporary pullback. Pullbacks that are not supported by the daily direction. Those ones are temporary pullback. Like the one that I got stopped out on gold. I was supposed to set my TP at maximum of 3.5 R,
Mm.
but the trade went for nearly 3 point, nearly 4. But it was overnight. I didn't set stop. I set take profit, but it was a little bit lower. I became a little greedy, and therefore
Yeah.
I realized that the market went but didn't tap me. So you can see this one. If you are patient enough, you should have taken it at around 3.5. If you want it 4 maximum, this is
Mm.
and see. This was nice one. Now, uh, so let's go. Let's check to finish the liquidity thing, and then I tell you the narrative on how nowadays I'm able to decide that now I'm looking for a range that are leading to sales or that are leading to buy. I think you can remember that I was using 4 hours as my go-to when I come to the chart. What will dictate what I do
Yeah.
that day is 4 hours. I can either decide to trade the pullback day or just chill out and wait for pro trend. Like Monday, when you are taking buys on I don't know it was on this pair or gold. I was just chilling out waiting for pro direction. Pro direction happened the following day. I was away idling. I didn't take it. Where is those? Where is those?
Mm.
So I had to be serious on Thursday, and on Thursday I got a very good trade. On Friday, due to NFP, I became lazy, but the direction was very much okay. Where is those liquidity things?
I like to buy after ENTERY that late buy.
This
Because
this was
I
NFP.
got a one. I think I got one, two, three out of that buy. One,
This
two.
this here or gold.
Around on decks.
Yeah, this should be the one because I can see this is the NFP.
Yeah, but that, yeah. After ENTERY, I took a buy and
Okay,
closed it.
okay.
I don't hold overnight anymore because I've been burned too many times.
It's
Because
sometimes
because
you can.
before your friend starts speaking, it was fine, but now when you speak,
Uh,
everybody's profit up and down.
yeah, it is Trump that is messing up things. So I'll show you where to pick. If you want to hold for long, I'll show you using 4 hours where to like uh
Okay.
where are those liquidity things that we were looking at? They've just gone away. Oh, this is paper stone.
Yeah, the first one. That
I'm
one.
wondering. I'm wondering what the heck is going on here. So weekly liquidity lows. Weekly, by the way, goes with 4 hours. If liquidity is taken on the 4 hours low or high, not 1 week, you shift to 4 hours or 3 hours.
Mm.
I've explained trend line liquidity. I've explained wages. Wages aligns with trend line. So there are this kind of wages. Uh, there are wages that are concave. There are wages. This is a flag. This is the this is for the cells.
Mm.
This is for the cells, and it must be choppy. Do not just mark any wage.
Yeah.
Then we get that, and we only mark wage on
That
5 minutes.
would be like in a pullback on a sell trade. That
Yes,
kind of
yes,
trade.
probably 5 minutes.
Yeah.
So this would be for cells. This is cells model. Now The opposite is true. If you want to buy, it should be sinking downwards.
Mm.
If it doesn't sink downwards, then you patiently wait for it to be sinking downwards.
Yeah.
If it doesn't do that, unless it has liquidated, and then uh, you can you can just take it at 5%. I'll show you an example of the one that has liquidated. So this is for buys. This is a range for the buys.
Mm.
Then there are this kind of wedges here, this one here, that are concave or convex. They tend to look like this. The reason why they tend to look like that is because you did not readjust your wage or trend line. If you readjust well, it will just look like one of these. But if it doesn't look like, if it looks like one of these, it just depends with the direction you want to go. That is when you should be seeing momentum. Like if you're looking for buys and then you see it a dip like this, that is okay. That is not okay. You need to see it going upward, then coming like this. If you're looking for buys, if you're looking for sells, you need to see it move with momentum. This it's called displacement or initiation leg. You need to see it move like this. Something like that after the market has been choppy. This is for the sell model. Why is this thing not responding? Why is this thing not responding? Can you hear me?